Research at Citi, Markets Edition.
Welcome to Research at Citi, Markets Edition, where we break down global macro in 10 minutes or less. I'm your host, Dirk Willer, Citi's Global Head of Macro, and with me today is Alex Saunders, our Quant Macro Head. Welcome to the show, Alex.
Thanks, Dirk.
We are recording this podcast at 9 a.m. on Monday, October 20th, 2025. One of the most interesting market moves has been the relentless rally in gold, which is seen as an expression of the debasement trade. We will discuss the debasement risk and what investors should do about it. Now let's start with the definition. At its core, the debasement trade is based on the fear that fiat currencies will be debased by either aggressive fiscal and/or monetary policy. And of course, you can see how these fears can arise in the US. We have 6% fiscal deficits as far as the eye can see, and there is a big debate about the independence of the FOMC, which also may be at risk. But it's of course also a global story. Fiscal globally is a worry, and even on the central bank independence side, it's not clear that it's just the Fed, as there are questions being raised post-election, for example, even in Japan. Now, what is the classic expression of the debasement trade? It's obviously long gold, but it's also, if it's a US-centric debasement, you would be short the dollar. And even if it's not, steeper curves would qualify. If the central bank cuts interest rates below neutral, then the curve steepens. And if you cut for reasons that are not just driven by weak growth, but for other reasons, then the curve should steepen even more. You would also expect rising break-evens, i.e. rising inflation expectations, and maybe even long equities could be part of the debasement trade. So at this time, really only gold is working, which is very interesting. Equities are up, but not because of debasement fears, but really because of the AI bubble. You could say, fine, maybe the dollar shouldn't weaken because it's a global debasement issue that people worry about. But why is inflation not up and why is the curve not steeper? Well, on inflation, you could argue maybe the risk is the US labor market weakening, and no one wants to be long inflation when the US labor market hits a trapdoor. And that's certainly true. The other reason could be that markets are bearish on oil. And whenever you're bearish oil, you probably would not really rush to buy break-evens, at least at the short end of the curve. So all that is true. And maybe with the steepener, again, you could argue that this mentioning of a third mandate would eventually mean that the Fed will manage the back end of the curve lower in yield terms. And so, you find a story for why it might be only gold, but it's a bit of a tortured story, we think. It does make us a bit nervous just how very narrow this debasement trade is at this stage. But Alex, another debasement trade that has been lost in action really is crypto. What are you seeing there?
Yeah, thanks, Dirk. Indeed, so Bitcoin is a potential debasement asset as well, often viewed as digital gold, given it has similar characteristics and a limited supply. The biggest difference is in the much higher equity beta, especially on the downside. This came to the fore in the week just gone, October 10th, when crypto sold off with equities on renewed US-China trade tensions. The correlations between Bitcoin and gold had been rising, which we view as a positive sign for that transition from a speculative asset towards the underlying debasement type properties, only for those correlations to fall back. In fact, after hours on the Friday, we saw a large sell-off in crypto futures markets as long positions were liquidated. This serves as a reminder that Bitcoin has more of a correlation with equities than gold, and it could have an impact on flows. That impact would present downside risk to our positive forecasts, especially if equity risks become more pronounced, given that Bitcoin trades above our anchor, which is based on user activity. However, we still think there is a positive flow story given the change in regulatory backdrop, the early stage of adoption within financial institutions. ETF flows have been persistent and they represent newer investors. Futures liquidations are zero sum and between leveraged and likely existing crypto holders in our view. So the important point is that it's not obvious that we're really trading debasement. It's very interesting, but Dirk, what should we do about it?
Yeah, that's a good question. So we had a very narrow debasement trade here. And let's dig a little bit deeper into gold then. The price action is very interesting. I mean, essentially, gold traded sideways between April and late August. And the news flow that caused the breakout was first and foremost the Jackson Hole testimony, basically suggested a more dovish Fed. And that's just normal. Gold likes to rally into the first Fed cut. Gold likes lower rates. Gold likes a weaker dollar, and all that was just textbook. But the interesting point is that both the rates and the dollar really got stuck after the first cut, and gold kept going. And that is, I think, partly because the third mandate was discussed, which really led a little bit to this, again, debasement fears. But now the question is, given that it's such a narrow debasement trade, who is catching up with whom? Will the other potential debasement trades get a bid, or will gold get stuck? And of course, there's a lot of news flow still to come about the Fed chair, about Lisa Cook. And that all will be important. But of course, the court case is next year's business, most likely. So we think actually gold is really quite stretched. And the rally probably has at some stage to at least pause. If you look at the deviation of gold from its 200-day moving average, there are only 7 instances since 2006 when it was more than 20%. Now it's almost 30%. And whenever that happens, you typically get actually a pullback in the order of 6% over the next 1 or 2 months. Currently, it's as extreme as in 2020. And so we do think things will eventually have to slow down. Now, we think the only reason why we don't worry about valuation in gold is that there is no valuation. If it was a stock, people, I think, would start to worry a bit more. And at this stage, we do think actually you really have to risk manage your gold positions really quite carefully. Make sure you have the appropriate sizing on. And everyone likes a bull market, and we like it too. But you really have to risk manage it carefully, I think. Alex, you did some work on positioning in gold as well. What are your thoughts on that front?
Yeah, so on the positioning side, asset allocators are long. They increased positioning in the last update that we did. It's one of the biggest consensus trades out there. So long gold together with short dollars. Flow-wise, to your point, Dirk, the ETF flows ex-China really picked up post Jackson Hole, and they've been positive since then. And then kind of more recently, a bit more high frequency, we see the rallies in gold being predominantly in Asian hours, and we see the China inflows on the ETF side picking up.
Great. Thanks a lot, Alex. So to sum it up, overall, the debasement trade is based on a sensible narrative, but it's a narrative, not a fact so far. The debasement trade is also quite narrow, really just in gold, and that raises question marks to us. So we do think you need to really risk manage gold positions quite carefully. Thank you very much for joining today. This episode was recorded on October 20th, 2025, and I'm your host, Dirk Willer. For more details, Citi clients can check out our report on the Citi Velocity portal. If you enjoyed the podcast, please leave us a review on your favorite podcast platform. Next week's Research at Citi Markets Edition will be hosted by Scott Cronert, Citi's head of US equity strategy. And be sure to watch out for our Research at Citi podcasts, which you can view on the same channel. The macro strategy team will be back in 2 weeks' time. Stay sharp.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyrights 2025 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.